All right, welcome to this explainer. Today, we're diving straight into some intense global economic projections to answer one massive question. What exactly will cause the next global economic crisis? We are seeing some serious flashing warning signs across multiple sectors right now, from energy to tech, and we need to understand the exact mechanisms of how these elements are projected to collide. So, what is actually going to trigger this financial panic projected for 2026? It's tempting to just point at one isolated event and say, yep, that's the cause. But real economic crises, they're rarely just one thing. It's a chain reaction. Today, we're going to map out that anatomy step by step. We can break this complex analysis down into four converging storm fronts: the global oil shock, tariffs and high rates, the AI bubble burst, and finally, the real estate anchor. Let's get right into it. Starting with front number one, the global oil shock, which is essentially the geopolitical spark. Okay, look at the sheer scale of this. Current stress tests show that a closure of the Strait of Hormuz would halt roughly 20% of the entire world's oil trade. I mean, we're talking about an immediate, massive disruption to the literal lifeblood of the global economy, impacting petroleum, LNG, and even essential agricultural inputs like urea used for fertilizer. And this isn't just some minor hiccup in the supply chain. When looking at the potential fallout, the head of the International Energy Agency impartially calls this the greatest global energy security challenge in history. It's kind of like the 1970s oil shocks, but on a hyper-connected, globalized scale where literally every country feels the pinch immediately. So here is how the contagion actually spreads. First, shipping halts. Second, Brent crude spikes way over $80 a barrel almost instantly. Third, major transportation networks start to buckle. Sources point out that highly leveraged airlines like Spirit, for example, face immediate bankruptcy risks just from the fuel costs alone. And fourth, it hits your grocery bill. Experts warn you could see a 50% spike in global food prices because, well, farming needs a ton of energy for both fertilizer and transport. Which brings us to stormfront number two, tariffs and high rates creating a structural inflation trap. This introduces a really ironic mechanism known as front-loading. Imagine a government proposes a universal 10% import tariff. Anticipating those higher costs, companies totally panic and start hoarding inventory right now. That sudden buying frenzy actually drives up inflation and chokes supply chains before the tariffs are even enacted. It's a psychological trap, and it generates immediate economic heat. Now, because of that stubborn inflation, fueled by both the oil shock and those trade tariffs, projections from major institutions like Goldman Sachs warn that rapid interest rate cuts, those are completely off the table. The 2026 reality is higher for longer. Central banks will be forced to delay cuts until late 2026 just to fight inflation. And keeping borrowing costs that high acts like an absolute vice grip on the rest of the economy. Moving on to stormfront number three, and this one is massive. The AI bubble burst and its lethal leverage. We really need to clear something up here because people love comparing the AI boom to the 2000 dot-com bubble, but there is a lethal difference. Back in 2000, that crash was mostly funded by cash and equity. Investors basically lost their own money. The 2026 AI bubble, though, it's dangerously fueled by systemic debt and extreme leverage, mostly hidden in the unregulated private credit sector. So, how does a localized tech bubble turn into a global banking crisis? Well, step one, tech giants overborrow heavily to the tune of $375 billion just for data centers. Step two, actual AI revenue totally stalls out and misses expectations. Step three, those highly rated tech bonds get abruptly downgraded to junk status. And step four, massive private credit defaults trigger systemic margin calls. Suddenly, institutions are fire-selling perfectly healthy assets just to cover their AI losses. Financial analyst Paul Kudrowski points out something absolutely crucial here. These vulnerabilities are completely interconnected. Think about it. AI needs incredibly advanced chips, right? Well, those chips are manufactured in regions that are highly dependent on that exact same Middle Eastern energy we talked about in Stormfront 1. A geopolitical shock doesn't just raise gas prices, it literally unplugs the supply chain of the tech sector. And finally, Stormfront number 4, the real estate anchor, which acts as a deflationary drag. Looking at primary source data from the China Macroeconomy Forum, we see the severe reality of a stalling property market. They highlight unprecedented debt-to-income ratios. When regular, everyday people are spending staggering chunks of their income just to service housing debt, they completely stop buying consumer goods. It just crushes domestic demand. And the sheer weight of this leverage is it's staggering.
Listed property developers are operating with nearly 80% debt, and household debt is sitting over 60%. If housing prices drop, or honestly, even if they just stop going up, this whole leveraged ecosystem completely freezes. It acts as a giant anchor on overall global economic growth, meaning when that AI bubble pops, real estate absolutely won't be there to cushion the fall.
Okay, so here is the climax, the perfect storm collision. What happens when all four of these hit at once? Let's map it out. First, severe energy shocks and front-loaded tariffs keep core inflation stubbornly hot. Second, because of that inflation, central banks are forced to hold interest rates much higher for much longer. Third, those sustained high borrowing costs inevitably pop the massively over-leveraged AI bubble, causing private credit defaults. And fourth, all of this happens while real estate stagnation limits any chance of a swift consumer recovery. They all literally trigger each other. Wrapping up this explainer, the sources paint a picture of a really fragile, highly interconnected global system. The exact mechanisms of the next economic crisis are incredibly clear. An energy shock hits tech, which bleeds into the credit markets, while real estate drags down consumer spending. Understanding this chain reaction is absolutely key. So it leaves us with one final vital question to think about. In a world of overlapping structural crises, is your portfolio prepared for the perfect storm?